All right, let's rock and roll, guys. We still got a lot to cover, and it's good times because it's financing, and I know you'll love it. How you doing so far? Everybody hanging in?
Yep.
I saw a couple of you drooping already. It's early. That's okay. Can't blame me for that. It is the finance section.
Now, if it's in my bank account, there's a lot of money, and my eyes be wide open.
It will be. It will be.
Yes, thank you.
When is a lot of money in your
There
bank
you go.
account?
Can't wait.
All right, so short sales. I don't know why they call them short sales because the only thing short in them is the name. The idea is that the bank is getting shorted, meaning they are not getting the money they're owed. If you borrowed $200,000, they're allowing you to sell it for less, and that is essentially the definition of a short sale. The lender is getting shorted. There's just not enough money to pay the note. This happened a lot during the recession. Actually, we made a living doing a lot of short sales because we gave 110 and 115% loans, no money down, stated income, graduated payments, escalated. We did all kinds of ridiculous lending. So because of the loans and some of the stuff that happened, a lot of people ended up being what we call upside down or underwater, and they just didn't have enough money or enough equity in their house to sell it and pay off what they owe. The market went down, the income didn't go up. Their mortgage, a lot of them were interest only, so they never went down. If they borrowed 200, they always paid 200. So a lot of people ended up underwater. So we ended up doing short sales, which means, you borrowed 200, it's now worth on the market 150. So we have to get permission of the bank to sell it for 150. So our actual short sale or a short sale contract is really a three-party contract: buyer, seller, and lender. Because the lender has to agree to allow the short sale. If the lender does not agree, we do not have a short sale. This is one of your alternatives to foreclosure. Essentially getting the bank involved early, letting them know, hey, things are going south. If you'll work with me, I'm going to try to get as much money for this thing as we can. There has to be a true financial hardship. You don't have any money to go with it. You don't have any assets that you could liquidate and satisfy them. It's truly and you had to write a hardship letter to the bank explaining why you're needed to do a short sale. Very, very complicated, a lot of paperwork. The biggest benefit to the borrower from this capacity is it looked better on their credit report. Down the road, they could buy quicker. It shows an attempt to future creditors that they attempted to satisfy their debts. And this was more of a circumstantial. Yes, ma'am.
With the deed in lieu and the short sale, are you still gonna have a judgment for the difference?
Usually, yes. The question was, are you going to typically have a judgment? And usually, yes. A lot of short sales, one of the things that we would try to work with in a short sale negotiation is that when the bank did authorize a short sale, they were assuming the sale as payment in full. So we wanted them to acknowledge, hey, you agreed to this, you're going to agree to this as satisfying my debt, so you are not going to come after me for a judgment.
So with all judgments though, you get 1099s, you have to record it as income, right?
Yeah, so that, and that alludes to the conversation we had a little bit earlier. If I did a short sale for 150 and we sold it for 150 and I borrowed 200, the bank could file a 1099 and say, hey, you made $50,000 in additional income that year. We gave you that income essentially.
So you're basically getting double whammy though, because it's going on your credit, plus you're having to pay taxes on it.
Yep. Yeah. Yeah, it's a challenge. That's why anytime you can, and again, this is why we as brokers have to take so much education. We are in charge of the largest financial investment of most consumers' lives. And it can be detrimental or it can be awesome. It can be just as this is bad, and you can end up in a real pickle, you could also end up making a lot of money off of it. So it's a double-edged sword that we kind of have to walk. So that's a short sale. Go back. Short sale, is it a material fact?
Yes.
So, yes and no. So the fact that we have a confirmed short sale is a material fact. What sometimes will come up, and you might see a question about it, is the fact that the borrower is behind on their payments a material fact?
No.
That's
Yeah.
not. So long as when we sell the house, we satisfy the debts. If we are selling the house for a shortage, meaning there is not enough money to pay the debt, we have a short sale, it is a material fact. And believe me, you want to know as a buyer because it might take you 3 months to close, it might take you 3 years to close. I did have one short sale that we negotiated for 2 years before it ever closed. That was after we got the offer, not on the market. We had a buyer and a seller willing to agree for 2 years before we ever got the bank to agree to let it close.
Explain again why there's the no part.
Uh,
Because if yes, they have to know in advance, because it may take so much longer.
Oh, and
What
I
was
should
the no
clarify,
portion?
the fact that it is a short sale is a material fact.
Okay.
Just be cautious on the whole, are they behind on payments? Is that a material
You
fact?
can't give details about it.
Right, the fact that they're behind on payments is not a material fact if we can satisfy the debt. If we can't pay off the debts, we really truly have a short sale, it is a material fact, and you have to list it as a short sale. or
But you
we
don't
call
give
it.
any details or how much you're short or any of that nature.
Right, yeah, we're not gonna give away, and we're gonna try to get as much for it as we can. Yes, ma'am.
In something like that that takes forever to close, does it just sit empty, or is the original owner still allowed to live there?
It depends. If the original owner's still there, they can live there. And if they've had to move, then it will sit empty likely. But yeah, we've like I said, that guy lived in his house for 2 years in that short sale and never make a mortgage payment. The banks at that time were so backed up that they. And when you get a short sale under contract, they essentially give you a period of time to close it. And they, meaning the bank, could never give us an answer, and so they continued to extend that period. And so they were fortunate to do that. Most pre-foreclosures and short sales end up in foreclosure because frankly it's a lot of work on the seller. The seller has to give a hardship, they have to show all their assets, they have to give them updated bank statements, they have to give them tax returns, they have to update them every 30 days. It's quite a challenge. And then the bank, which is usually a lot of times a mortgage service company, is trying to negotiate with investors on the backside, weigh in their options on the insurance that they have in place, as well as what investors will pay for it, to kind of get back to you to see if it's an allowable margin that they can sell it for that.
So that 2-year time, was that just because they were so backlogged, or was it just because they could never come up with
A little bit of both. The bank was very non-communicative, and in fact, it got sold. The bank itself was sold during the time frame. There's a lot of complicated issues.
So one of your buyers didn't walk, I mean.
Yeah, and that's one thing I will tell my folks. If you have a timeline at all, don't buy a short sale. Because if you have to be in a house in any particular time, and that's why a lot of investors will look at short sales as investment options, because they can put an offer in, and it may take a while. Yeah, just let it ride.
What's the short,
Let me get her and come back.
So the benefit to the owner, well, not, person that's getting to do this versus a foreclosure is that this does not affect your credit score as
Does not
badly.
affect as badly.
It still affects
Yeah.
it.
It's still bad.
Most of the time, and these are just kind of rough numbers that I was told, and I have no factual evidence behind it, but foreclosure was usually 5 to 7 years before you could buy again. Short sale was 3 to 5 years, so it was a little bit shorter.
And there's programs now though where even a year.
Yeah,
to
we've had
a
people a year out of bankruptcy and buying houses.
And buying houses.
So
Yeah, in some banks, we've seen that some banks will really work with you and some are just total jerks. We
Yeah.
had one client who was trying to buy a house and showed, on her credit report, showed like a $45,000 judgment. She had tried to short sale it, had an offer of $5,000 less than what she owed on
Oh.
it. They refused to take the offer,
yep.
although it was only a $5,000 difference, foreclosed on it, added all these fees, put a $45,000 judgment on her credit
Wow.
report, and then
Wow.
when Natalie helped her call the bank, trying to get everything taken care of, because she never got anything in the mail telling her anything about it, never received a 1099, went to the bank had not done the correct paperwork through an attorney, and ended up having to eat every penny of the
Oh.
$45,000.
Good for
Good
them.
boy.
Well, they deserve it.
Good for them.
Yeah.
Yeah, and that's unfortunately the nature, and I can tell you short sale after short sale after short sale stories that are just like this. When you have a bank involved, a third party corporation that is not a person but a department of
Yeah.
people, you
They don't
never get
You never
care, you
stick to
never
the
get
same
empathy,
person.
you don't get
That was
responsive.
state employees credit union.
Really? Good for
Uh-huh,
them. That's interesting.
yeah.
I would give, well, I won't talk about that, but yeah. Other questions on short sales? That's kind of the gist of it.
What's the shortest short sale you've ever seen?
We did one
90 days.
45 days. It was actually kind of cheap. It's not really a short sale. It was a short sale, and then they foreclosed on it, but we had it under contract as a short sale. And when they foreclosed on it, the bank's like, "You got that buyer still?" We're like, "Yeah." They sell it to them. So we kind of sold it as a foreclosure, but it was sort of a short sale too. How can the broker, or what can the broker do? So this is an important part of it. I'm not going to tell you what I did. I'm going to tell you what you're supposed to do. So as a broker, we are not attorneys. I've told you this from the onset. The best thing you can do, mostly from your liabilities perspective, but also from your time management perspective, is to engage the services of an attorney. An attorney will have a consultation with your client. They will speak to the bank on the client's behalf. They will charge a fee that will be charged on the closing statement that comes from the proceeds. So it's not something that your client should have to pay up front. But you should help gather the documents necessary from the lender. You should not negotiate anything with the bank. That's not what we do. You are better off to kind of outsource that to a short sale attorney. Questions on that? Essentially, engage an attorney if you get in this route, if you can. Now, we are allowed, and you will have conversations. You will explain, hey, this is short sale. This is what a deed in lieu looks like. This is what foreclosure looks like. Where are you at on your mortgage? What kind of notices are? How far behind are you? So these are the conversations you'll have. You're going to guide them to the best resources.
Generally, what's the rule though, when they tell you how far behind they are, what's the rule of being past a short sale versus a foreclosure?
If they have a sale date, if they've been given a sale date, then usually at that point it's too far. That's when I start talking to them about deed in lieu, voluntary surrender. Sometimes the banks will offer what they call cash for keys. It says, I'll give you money to get out of my house and give me the keys back to a good, clean house. And I've seen people get as much as $5,000, $7,000, $10,000 for cash for keys. Hey, foreclosure is expensive. Take the key, take the money, get out of my house, relocate, leave my house in nice, clean condition, meet me here, give me the keys, and we'll call it. It's still a foreclosure, but it's a cash for keys, so it's more of a friendly foreclosure, I guess you could say.
Why would they give them cash if they haven't even paid their?
To get them out of the house, so they don't
put
destroy them.
concrete down
Because it
the
must be-
toilet
it
and
must
they
be
don't cobble
cheaper.
the pipes.
Yeah.
That's what they do in foreclosures.
Yeah, a lot of foreclosures get
Oh,
destroyed
yeah.
on the way out the door because
Yeah.
the borrower a lot of times is mad at the lender.
Yeah.
They're saying, hey, they're the ones that have cost this, they're the ones that gave me that loan, they jacked my rate up, blah, 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 blah. So fine, if they want the house, they can have it.
Yeah.
So the difference between a foreclosure is an involuntary, right? Upon default, the deed in lieu, lender, and the borrower avoid foreclosure proceedings if the bank agrees to take it back. In a short sale, the lender consents to the sale, accepting less than what is owed to release the lien. So just a couple of quick definitions here, the little differences. All right, subject to or assuming a mortgage. Subject to, the seller remains personally liable while the buyer does not. With an assumption, the new buyer is liable for the debt. We're talking about loans, okay? A subject to loan versus a loan assumption. The seller is automatically released from liability in the event of a novation. Because remember, what's novation?
Where you get a new contract to replace the
New contract, new party, right? So if I'm the party to the contract, we do a novation, I'm no longer part of the contract. So then I'm released from my liability. And rarely occur is they will trigger a due on sale clause. So with a loan assumption, they don't happen that often because if I have a loan and now I want you to have the house and take over my loan, I am going to give you the deed. Well, if I'm giving you the deed, it's going to trigger a due on sale or alienation clause that says you are now selling or transferring the property. You owe us the entire mortgage, right? You can't sell your house and still have a mortgage on it. So if because most mortgages will have a due on sale clause. So if you have a due on sale or alienation clause, same thing, it's going to be triggered. So therefore, loan assumption is not necessarily an option. Now, a lot of loans are assumable, but they ultimately result in a novation. It's you qualify for the loan, same as anybody else. You can take over the terms of my loan, but now my loan is your loan with the bank. So typically, if it does exist, it's with a novation, so you have a new, and I am released. So that I'm allowed to avoid that due on sale clause.
So the seller has no liability.
So the original owner does not, correct. Yeah, because very rarely we find a kind of a third-party instrument where I'm the seller, you're the bank, and I bring in a buyer, or a buyer who wants to buy it, and all three of us are still going to be in it. Where I have a liability, they take over, and you're still the lender.
Is that what the subject to?
That's what the
basically
subject to is. Yeah, subject to essentially is that third-party instrument that exists. And most of the time in any kind of assumption, I want you as this person selling want to get out of the picture. So it's a lot of times I'm out of it. We're gonna do a novation. You can assume it, you can take it, but I need to get out of it. Because of the due on sale, they don't want me still in it.
Where it says seller's not automatically released from liability, is that just because they do the process? I mean, they will eventually be not liable, they just
So-
have to go through a period of getting all the documents and everything redone?
And it varies. And we're thinking a lot of residential stuff too, right? In the commercial world, these things happen a lot different. In the commercial world, lending is not governed nearly to the extent that it is in residential. In the commercial world, or in the residential world, we assume people buying residential real estate are not doing it on a regular basis. We're buying it to live in. We might buy it every 5 to 7 years. Commercial world, they assume you have a little more education. You are probably investing in commercial real estate for a reason. This is a part of your business model. So in some cases, there might be a novation where I would still assume or keep part of that liability. This happens a lot of times in leasing, commercial leasing in particular. I sign a lease, I'm on the hook for the lease, I sublease, okay? So I'm still on the hook, but we have a new lease between you and the landlord, and I'm still I'm essentially reliable. If they don't pay the rent, it still comes on me. But may is a word that you will need to watch for. You will learn that in this class there is not a lot of absolutes. There is not a lot of this is always or never. There's a lot of mays. And so while most of the time the novation does absolve me of the original liability, it may not. And there are instances, and particularly in the commercial world.
I don't think we've had any absolutes, have we, except death and taxes.
Pretty much, yeah. I think that's probably true. What happens when the seller has a mortgage on the property and sells it? Well, the seller's loan must be paid off at the closing, right? So that's why we get payoff. If the buyer is obtaining new financing or if it's a cash sale, either way, we have to get the seller's payoff to satisfy their note. If there's an assumption, you must get an approval from the seller's lender, unless there's a release through the novation. The new buyer is then primarily liable, and the original borrower becomes secondarily liable. Yeah, secondarily. That's a fun word. Roads.
What?
So in an assumption, you are essentially taking over the terms of that loan. You're almost like a sublease, typically, of the original borrower. In the residential world, in a typical loan assumption, the original borrower backs out of it, and there is no reliability there. But in an assumption, the secondary person, the sublet, so to speak, is still paying the bills, but if they default, it's still on me.
There's not gonna be an instance of an assumption where the original sellers are gonna still be liable in a residential sale.
This is just commercial.
Yeah, I mean, because the class addresses real estate in its broadest terms, we're looking at all of it. But yeah, if you really drill down to residential, you're not gonna see this there. Purchase subject to the seller's mortgage. The original borrower remains liable if the new buyer defaults. So again, if it's subject to the seller's mortgage, I still have the original loan, and if I default, I'm still on the hook. So it really becomes kind of a three-part. It's like a buyer, seller, somebody else is paying for it, but if they don't, I'm still on the hook. And that's where that original liability can lie with the first person.
Do we do those in North Carolina, subject to?
Not in residential. There might be some in commercial. And there's all types of lending too, and not just banks. There's also like hard money lenders, private money lenders. You know, if somebody's just got a big retirement account. We get this a lot from people up north. They have $1 million in their retirement account. They can lend it through hard money lending and make money off of interest and fees, and it still feeds their retirement account. So they're essentially a private bank, and so they can have whatever rules they draw up.
That must be nice.
Yeah, there's a lot. You'd be surprised. And as brokers, you'll need to get to know those because
And what do
they.
you call that? What do you call that?
I call them hard money lenders.
Hard money lenders.
Yeah, because they're not a bank. They're just they have cash. They're not selling it. It's literally their cash. They're letting you borrow it for a note.
Kinda like owner financing.
Yeah, kind of like owner financing. Yeah, because they're essentially they just paid for it. So what are the essential elements of a mortgage or a deed of trust? Now we talked about the essential elements of a deed. This is deed of trust / mortgage. Has to be in writing per statute of frauds. Have to be competent parties, lawful. Can't have there's no such thing as a legal contract for an illegal task. Valid interest, legal description, the mortgage clause, including deed of conveyance, meaning that you are getting it in a title theory. The lien theory will have the intention to mortgage, meaning I am the borrower, I am giving you the mortgage. A defiance clause, and delivery and acceptance. The defiance clause says once it's paid in full, I get my legal rights back. And then delivery and acceptance. All right, couple of special clauses that you need to know about. No Santa Clauses tonight. That's coming in like 6 weeks. Mortgage notes have special note provisions. Let's look at some of them. Acceleration clause. The acceleration clause, I need you to remember that when you hear acceleration, think default. Acceleration clause means you are defaulting. You are not paying your mortgage. We are accelerating the payment schedule. The borrower has failed to pay, so the bank calls the loan due. I'm calling the whole note. The borrower must then pay off the entire balance, not just the amount you're behind.
Wow.
So the acceleration clause says, hey, you got behind, pay me all now or you're foreclosed on. Yeah, be careful. This is another one of those that can be in a note. Very bad. Not going to see this typically in residential mortgages. Prepayment penalty. Also, no longer very much, actually North Carolina doesn't allow prepayment penalty, but there's not a lot of these that are in existence that says if you pay it off before you're supposed to, you pay a fee. Now, I say that residential mortgages don't allow this. There are a lot of this in commercial. As a matter of fact, I'm closing on a commercial deal next week that had a prepayment penalty. The banks make their money off the interest.
Yeah.
If you pay it off early, they don't make much money. So they're like, great, we're not making as much money, so you're just gonna pay us a fee for that. It's called a prepayment. You would think it would be like, oh, you pay them off early, they like that. No, they like the interest. That's what they like. We'll do some math in a little while and you'll know why they like that interest. But a prepayment penalty says that if you're gonna pay it off, now FHA and VA loans, it's not allowed, which is why typically in a residential mortgage, you don't see these a lot for those types of mortgages. But his prepayment penalty was, it was staggered. So if it was in the first year, it was a certain percentage, second year, another percentage. We're in his third year, and I think it was something like 1%. So it was gonna be like an $11,000 prepayment penalty. We could have actually closed last month in September, which would have been cool, but October was the next year. So we're like, we're gonna wait, we're gonna close in October, so the prepayment penalty is a little less. Saved him like $12,000. He was happy. So that's the prepayment penalty. Now, do not confuse alienation with acceleration. Remember, acceleration is default. Alienation or due on sale, same thing, means I'm selling it. The deed is changing hands. Anytime there is an exchange in the name of, or change in the name of the deed, it's going to trigger a due on sale clause or an alienation clause that says you've got to pay off the entire loan before the property gets transferred. Most mortgages have this in effect. So if you're going to sell or give your deed to somebody else, you have to pay us in full first. This is the reason you don't have a lot of owner financing with people who have a mortgage. They could continue to make the payments and owner finance it to you. But if they're going to give you the deed, it's going to trigger their note being paid in full to the alienation and due on sale clause. So don't confuse alienation and acceleration. Both lots of A's, right? We love alliteration, I told you. There you go. This one's default, this one's for sale. Question on those? All right, mortgage payment consists of principal and interest. So every mortgage payment that you're gonna make, some portion of it's gonna go off your principal balance, and some portion of it is going to be an interest, i.e. profit for the bank, okay? This can get deeper, hold on to your butts. All right. Now this one I got dinged on from the real estate commission when I sent in my video because apparently I said it wrong. I was saying something else, but I went to Google. I'm like, how do I say this? And so now the only way I know to say it is the way that Google said it, and it is amortization. So, a gradual repayment of a fully amortized loan will take your balance to zero at the end. So if you, for example, have a 30-year mortgage and you make 365 payments, and it is a budget mortgage or a level mortgage and everything's the same, and then it is considered to be fully amortized. Therefore, it goes from what you owed to your last payment goes to zero, all on a scheduled task, right? Partially amortized means that you will not have paid it all forward or paid it all off at the scheduled time. So you may have a 30-year amortization schedule, but it has a 20-year balloon. So in 20 years, you will have to pay whatever is left. That's called a balloon payment. Or the interest rate could change, which would change your payment. Some of them are what we call an adjustable rate mortgage. The rate goes up and down, but they have caps, meaning that the rate can't go up, but so much. So if the rate cannot go where it should go to make it fully amortized, you may have, at the end of your 30-year, a balance, meaning your loan was not fully amortized. So this is what it should look like in your mortgage world. You start with the $250,000, you're going to make payments, and at the end, it's going to go to zero. Now notice, at the beginning, it's mostly interest. This is an important concept to wrap your brain around. Because if you sell someone a house and they call you 3 years later and they bought it for $250,000, they are going to owe $249,999. Not quite that extreme, but they're not going to have a lot of equity. And so they don't understand that there's a cost of sale. They're going to have an expense to sell the property. Repairs, getting it ready, commissions. It's going to cost them some money to sell it. So the reason we look for year 5 to 7 is that by that time, assuming appreciation, assuming the house is still good, and assuming they've been making their mortgage payments, they have equity. Meaning they're going to call you like, hey, sell my house. I'm like, great. Not only can you pay me, but you're going to make money too. This is a good thing. This is a good thing. I do not want them to call me in year 1 or 2 because they still haven't paid down their mortgage very much. There's not a lot of equity gain. You'll realize, and we'll talk about it, there's a couple of different ways to gain equity. Equity is the difference between what you owe and what it's worth. Okay? So one of which is paying down what you owe. The other part, or one of the other parts, is that it appreciates, meaning it's going to go up in value because of inflation, essentially, but it's going to go up.
Or if you do improvements.
The other thing is if you make it better, right? You're adding improvements to make it worth more. So this is interest, this is principal. At the time of purchasing a house, if you're getting a mortgage, a residential mortgage, they're going to give you an amortization schedule. It's going to make you vomit. I actually tell my buyers, I'm like, you don't want to look at that. You don't want to look at that. Because you are borrowing $250,000. Combined with all this interest, it's usually 3 to 4 times that. So you might end up paying back as much as $600,000 or $700,000 to get a $250,000 house. If you keep it for the full 30 years. And only pay the minimum mortgage, which is what most people do. So, it leads us to our first math venture of the night. So the loan divided by your house value is going to give you what we call your LTV, or your loan to value ratio. Your loan to value is how much of what the house is worth will we loan you. And you've heard me talk about earlier tonight that we were giving 100 and 110% loans. Meaning if the house is worth 100, that's what it was actually appraised at, we would give you a loan for $110,000. You are already $10,000 upside down. Not a good idea. So because of that, we actually went the opposite extreme where it was much different. Where we've landed now is much more practical. And so most mortgages, if you're buying a home, you're going to have minimum 3.5% down most of the time. I don't know, there's a few 100% loans, but they're very reserved. Most of the time you're going to put some money down. A conventional mortgage is going to be 5 to 10% down, and you can put down obviously as much as you want. But that loan to value from the loan product is how much of the value of the house will the bank loan you. And a lot of times it's not 100%. So if it's 85%, then if it's a $100,000 house, it will have to appraise or I'm sorry, they will let you borrow 85,000. If it's 85%, the bank will give you 85,000, meaning you have to bring $15,000 down. So 15% down, 85% LTV. Make sense? It's the max amount they're going to lend, the lesser the sales price or appraised value. An example there is $200,000 sales price divided by $195,000 appraisal means it's an 85% LTV. So you can take the amount you're borrowing, divide it by your value, and that's going to give you your LTV.
Do you ever tell your buyers about the, I forgot the name of it, but where you can get 100% finance and there's a.
USDA?
Yes.
Yep. So as
And then
brokers,
you have to-
you'll need to know your products.
Yeah.
That's why
And you gotta check
Jennifer
that
works for a
box.
lender, and that's why we bring them in your post-license class. Actually, they come to pre-license too, we need to give them, to talk to you about products. Again, I'm teaching you about lending. You are not going to be loan officers. You're not expected to know all the ins and outs of lending. You are going to be expected, and your consumers will expect to say, hey, what are interest rates around right now? What kind of loans are out there? Can I get 100%? Where do I get a note that I don't have to pay, or that I can walk into the bank? So you're going to know some general things. We're going to get you pretty in depth in it, but you're not going to be expected to know everything. And in fact, the real estate commission is going to tell you you're not loan officers. Don't act like one. Send them to a loan officer. By the way, the next 4 hours of your class, I'm going to teach you to be loan officers, because we are going to do a lot of their math. And this is the first step. So equity, again, is the value of your house minus what you owe. That's your home equity. How do we figure out what your house is valued at? Yeah, appraisal. Remember, be very careful with the word value. Value is typically reserved for appraisers. In the kind of layman's terms and the real estate brokers, and we throw that word around a lot, like, hey, if you want to know your house value, call me. I'll do a CMA, right? Comparative market analysis, and we'll figure it out. Well, that's not what we do, at least not in this class. We determine probable sales price. Like, what would we list it for? Appraisers give an exact value on an exact day. The appraiser will come out and say, hey, today, this house is worth $149,615.33. They're gonna call us and we're like, hey, yeah, we could probably list it somewhere between like 125 and 130. Let's do that. So we're gonna give them a range, an appraiser's gonna give them a value. And so that value is what we're minusing from what we owe to determine what our equity is.
You're rarely though gonna have a sales price that's gonna be over the appraised value though, is that not right? I mean, because you're gonna go back to the seller and say, it didn't appraise for this.
Yeah.
Cause that's gonna be hopefully within your due diligence period, and say, you know, we'll give you what it appraised for. Cause no one's gonna buy it for more than it's worth unless somebody just really wants the house and is willing to do it. But
We've had it happen. We had it happen one time, I think. What she's asking is, you're never going to really have. You rarely will have a purchase where a buyer is going to buy a house for more than what it appraised for, more than what the value is. And so while you're under contract with a house, your lender is going to order an appraisal to make sure that they are giving you the LTV that you need. And if the appraisal comes at purchase price or below, we're golden. If in fact it should appraise for less than what we're buying it for, no, the other way around. Yeah, no, that's right, less than what it's buying for. So they say if I'm buying a $100,000 house, the appraiser says it's worth 90. We're under contract to buy it for 100. The buyer doesn't want to pay $10,000 more than what it's worth. So we do often tend to renegotiate if possible, or the contract terminates. We did have one that was like $1,000 off, and the buyer brought the extra $1,000 out of pocket, and they were okay with it. Because at that point they were pretty invested in the process. But they very rarely do you get an option where they're going to pay more than what the value of the home is.
well, and I heard a lot of agents who, when houses are flying off the market and they're the whole highest and best offer, where
Yeah.
people were offering way more, trying to get it under contract, and then once the appraisal came back, if it didn't appraise,
Renegotiating.
they were renegotiating, and then there were other offers that would have been better, or, you know,
And this would have closed.
it would have closed, and that they were really upset about that.
Yeah, that's one of the things. When markets get extreme, people do stupid things.
Yeah.
Not necessarily ethical, but they do stupid things.
Oh, so they purposely
Overbid.
offered a lot.
Oh,
Yeah.
I'll give you $1 million for a $100,000 house. Great. Well, it only is going to appraise for $100,000. Great. Well, I wanted to give you 100. Bank's only going to loan me 100. You okay with that? I want to give you $1 million, but they're only giving you
They,
100.
they, basically, they were trying to get one foot in the door to,
Beat everybody else.
yeah.
Wasn't a good plan. Equity increases with a couple different things. You're going to pay down your debt. You're going to increase the house is going to increase in value through appreciation, and then you're also going to make improvements that are going to increase it. And typically, your appreciation is one of the best things that goes on in your real estate investment because it tends to appreciate automatically. As long as you're maintaining the premises and keeping it up, nationally, since we've been tracking appreciation, it's historically been somewhere between 3 and 4% across the country every year. That's good. That means your $100,000 house last year is worth $103,000 to $104,000 this year. So that's why real estate's a good investment typically, unless you're buying in the recession, and that didn't happen. But still, even with the recession included, the average was 3 to 4%. So usury. Usury laws are in effect, and essentially they are laws that protect interest rates. Interest rates cannot exceed legal limits. Usury laws kind of are set to protect or prevent predatory lending, meaning, you got really crappy credit, you got a really bad history, we'll give you a loan, but it's at a 20% interest. So that we can make a lot of interest. We know again, it's kind of a calculated risk. I'm going to make as much interest off of you till you default. I'm going to take the house back. I'm going to do it again. So usury laws, just in general, not just for mortgage, but for anything, put restrictions on excessive legal limits for interest rates. Now, loan fees, good times. So the loan origination fee or discount points are fees to the lender. The loan origination fee is essentially the commission to the loan officer, the person who is originating the loan. So we get commission as real estate brokers, right, when we sell a house. The loan officer gets a commission typically for originating or getting the loan. That's called their loan origination fee. It's often expressed as a percentage of the loan amount. Discount points, we're going to talk about that. Also a fee to the lender, but it's essentially, you can write discount points or consider them prepaid interest, because you are giving the lender interest up front so that they'll reduce your interest rate so that you pay less interest later.
Just buying down your rate.
Yeah, you're buying down your rate, but it's a fee to the lender. And they are both based on the loan amount, not the sales price. Very important distinguishing point. They will always, always, always give you more information than you need. When we're talking about loans, we need the loan amount, not the purchase price. Going back to that LTV, loan amount or origination fee and discount points are going to be based on the loan amount. Well, if it's an 85% LTV on a $100,000 house, my discount points and loan origination fee are based on $85,000, not the $100,000. That makes sense. We're going to do some examples. Actually, go ahead and take your break because you're zoning out. We're going to do some math next. Go ahead, take your break, come back, and then we're going to do some discount points.